I'm James Turk. I'm a director of the GoldMoney Foundation, and I'm here in Munich, Germany with Eric Sprott, founder and chairman of Sprott Asset Management in Toronto, Canada. Now, Eric, we're here at the Edelmetallmesse conference in Munich, which is one of the largest gold and silver and mining conferences in Europe. What are your impressions of this conference?
Well, as I mentioned in my speech, I'm very impressed by what's happening here. I think the thing that most impresses me as a North American who's attended his first conference where we actually transact business in precious metals, I am shocked at the level of activity in terms of people buying substantial quantities of gold and silver coins. I'm most impressed by it. And there's so many vendors here. So it's been a great conference. It's probably one of the best attended conferences I've ever been at. I think they say there's 7,000 people here, so it's been quite encouraging to come here, and thank you for the recommendation of coming here, by the way. And I think it's been a wonderful experience for us.
Yeah. In your presentation this morning, which was entitled Mania, Manipulation and Meltdown, I'd like to talk a little bit about that. What was the major theme that you explained to the audience?
Well, the mania part was the NASDAQ mania, when things were trading at ridiculous values and you knew that you had to go into a bear market. The manipulation part was all those things that governments now do to try to prevent the normal flow of a bear market. And you know, a lot of us would have thought to ourselves, surely to goodness we can't have a zero interest rate policy in the developed world. Surely to goodness we're not going to print money. Surely to goodness we can't run deficits of $1.5 trillion every year before finally someone says it's not going to work. So all of those things I kind of put into the category of manipulation, and where things are never allowed to really go bankrupt, where it always gets taken over, so there's never a liquidity event, so that the financial markets never experience that Lehman moment again when they, you know, literally almost closed the banking business down, where we're within hours of closing it. So it's this always coming to the rescue and never allowing what should naturally play out. I describe that as manipulation. And then the meltdown part would be, you know, what ultimately happens? Do we just keep printing money? Do we keep relying on central banks? Do we keep relying on governments to develop stimulus programs and have increasing debt? Or do we someday have to face the music? And the music it will result in a meltdown, one way or the other. If we come up with austerity, we'll get shrinking GDP as we experience in Greece. Once GDP went down, of course, the bond rates, the interest rates went through the roof, which put them in a death spiral. And we may see that in other countries as these rates start going up into double digits, and there's more demands for austerity. The more austerity, the more the deficit goes up, and the more the interest rates go up. So I don't know how we get out of it. I don't think we get out of it by having austerity. I think, you know, we'll just bring on the difficulties faster, and I think therefore they've opted to print money, and let's just see if we can extend and pretend and keep it going and hope that things become normal. But ultimately that would probably lead to some form of hyperinflation. So
printing money is obviously not the solution then?
Well, I think most careful people are very aware that printing money debases currencies and makes things that are real more valuable denominated in the currency. And that's why you and I are so involved in gold and silver and trying to suggest to people that there's not an easy way out here, and that in either scenario, gold and silver seems to be the obvious place to invest your money.
Yeah. When you talk about meltdown, you're talking about another Lehman event or something worse?
Well, no, what I think of is, well, I think of something worse. I think of people losing confidence in the banking system and in governments, because a lot of the banking problems have been transferred to governments now. And of course, the government would be translated by interest rates going to very high percentages, which of course would create bigger deficits than we already have. And finally, someone will throw up their hand and say, we just can't deal with this, and there'll be some kind of financial collapse. And my ultimate expectation is that people will realize that having money in banks is a risky proposition for no return. You get paid nothing to have your money there. Why do you take that risk? If you had money in Dexia and the governments hadn't come in to bail you out, you as a depositor would have lost money. And it's not worth getting 0.1% a year or 0.5% a year to take that kind of risk. And as people gradually come to that determination, I think the money will come out of banks and go into precious metals.
Well, that's an important point, because I think people already understand the inflation risk, but what you're basically suggesting is that people are only now starting to come to grips with the counterparty risk.
Sure. And of course, we've seen it manifested. We've seen examples of companies who've, I don't know if they've announced it, but it's become public information that they've taken their money out of the banks. And I think thinking people realize that there's a risk element because, of course, of all the counterparties, things that you've talked about for a long, long time. And you know, once this thing gets ahead of steam and everyone's trying to put it with the top bank, all the lower level banks, of course, lose their deposits. They have to sell something. Well, as it turns out, there's nothing to sell. I mean, you want to sell a stock and it's down 25%. You want to sell a European government bond and it's down 10%. And of course, they don't want to throw up these losses on their income statement because it'll become more apparent that the capital's at risk. So they're in a precarious position where normally you have to fall back on governments now to inject money into the banking system.
But that's the liquidity event that you spoke about in your presentation this morning, describing the Lehman collapse as but so you see this ultimately recurring?
It almost has to recur. And it's only a question of why does it recur? Does it recur because, you know, they actually go to austerity? Does it recur because people just lose confidence in financial instruments and paper money? And it looks now like the more likely thing is they're going to lose confidence in the banking system and paper money.
Well, it also recurs because of the point you made this morning about the leverage in the system. That, you know, there's, as you explained, there's just too much leverage.
Yeah.
So
the average person doesn't appreciate the leverage, though. I mean, the average guy
or the
in the
danger
street,
of the leverage.
I don't know. He has no idea. I mean, yes, analysts would understand what the leverage is, but I don't think the average person would. What they would probably understand is if, for example, we had another Dexia soon, then people would start linking things together. Maybe we could say that MF Global was the same as Dexia. It's not really because it's an investment dealer, but you know, if you had another situation where all of a sudden some bank has to be taken over by governments, maybe people start connecting the dots and say, well, who's next? And you know, what's my risk of losing money in the banking system?
Mm-hmm. So in terms of the banking system, that's inherently what you called the fundamental flaw?
Sure.
The fact that it's just too highly leveraged?
Yeah, well, I mean, as I pointed out, you know, in a 20-to-1 leverage, and I think, for example, banks in Europe are more than 20-to-1 leverage. If you have $1 of assets, you can only lose 5 cents before you have zero capital. And when, for example, on the typical Friday night in the US, when a bank goes down, they actually lose 30 cents in the dollar. So they're losing their capital 6 times over. I mean, what's the chances of not losing 5 cents in a $1 investment, no matter what you're in? Government bond, mortgage, investing in the stock market. I mean, that's almost a daily occurrence.
Particularly given the fact that prices were bid up so high in the previous boom that they reached levels that were just not sustainable, price levels that were not sustainable.
In many things, whether it's housing or various financial, the whole derivative thing that is so complicated. I mean, you know, the level of derivatives that aren't even on the balance sheet is staggering.
Yeah.
So even when you're looking at 20-to-1, you have no idea whether it's really 20-to-1 anyway.
Yeah.
It could be 50-to-1.
I'm not even getting to the derivatives. It's bad enough just looking at what's more or less visible in terms of the way the banks report numbers.
Totally.
Speaking of which, you know, when I first was trained as a banker back in the late 1960s, it was prudent to have a loan-to-deposit ratio of about 0.7, 0.75. So in other words, you had more deposits than you had loans. I don't know if you're aware of this, but in Europe now, the loan-to-deposit ratio is 1.2, which just goes to show how sensitive these guys are to funding needs, and it explains why these guys are so panicked, because the traditional funding sources, money market funds from the US and things of that nature, have been turned off. So in order to get from a 1.2 loan to deposit ratio to a 0.7 or even a 0.8, a lot of assets have to be sold. Now those assets are not going to be sold anywhere near their face value, which means that a lot of losses are going to be taken, and that's going to erode capital bases. So. I guess
there's no one to sell them to.
Yeah.
Because everyone's doing the same thing at the same time, right?
Yeah.
Banking systems throughout the world are too levered. So who's the ultimate buyer? I guess the government can be the ultimate buyer, which has already happened, right? In the sense that they'll buy your sovereign debt from you here in Europe. They'll let you sell sovereign debt, and the Treasury buys Treasury bonds. And that's been one thing that's happening, that the banks are able to at least sell the bonds because in essence, the regulator comes in to buy them.
Well, the banks can try to move the assets around to make them believe that make the market believe that those assets have disappeared, but they really haven't. And one of the things we're seeing on both sides of the Atlantic is not only the quantitative easing by the central bank, but the qualitative easing, in the sense that the central banks, by buying a lot of these assets, the Greek debt that isn't really worth anything, and now the worries about the Italian and the Spanish debt, the quality of the assets on the central bank of the ECB, and even the Federal Reserve did this with a lot of the mortgage paper that they've bought. This qualitative easing on the asset side is just as harmful as the quantitative easing on the liability side by increasing the quantity of money.
And of course, there's no accounting for that, right? Because who would even deem to question the Fed or the ECB, even though people like yourself and myself realize exactly what's going on? But obviously, the average guy in the street doesn't even think about it. They don't even look at banks, let alone the central bank. And so there's this almost license to be irresponsible, which of course, having been given the license, they've used the license. But there's no question that, I mean, as these central banks get involved in buying bonds, they're just losing money.
Yeah.
But there's no accounting for it.
Yeah. I wrote a monograph a few years ago explaining why central banking was the barbarous relic. And here's a good example of it, basically how they're destroying the currency. Because once you erode the currency and the currency's usefulness, you're ultimately destroying the economy. And when the economy is destroyed, then everybody's hurt. And I think that's probably the beauty of what the Bundesbank had, in the sense that it was politically independent. And they guarded that independence. But would you agree now that the ECB is very much a political animal?
Totally. Well, I certainly think it. When Mr. Draghi's been there for all of like 2 days and he immediately cuts the rate by 1/4 of a point, not that it makes any difference, but it's, acts as some kind of stimulus for the market for yet another day until we all figure out that that's not going to make much difference.
Well, it does make a difference in the sense that inflation is already over 3% in Europe, and that's above their target. And I think the actual inflation rate is higher than what the stated inflation rate is. So that's just putting more inflationary pressure, and ultimately is going to debase the currency even further.
Absolutely. Well, we certainly agree on that. And even when I think of, the real rates, the more they're going more negative. And of course, negative real rates is very positive for precious metals, because how do you maintain your purchasing power?
Yeah. Well, is there any other alternative other than gold and silver in terms of where you want to keep your liquidity?
Not liquidity, no. I mean, there's things that maybe you can invest in and survive, such as, maybe productive farmland or farm chemicals.
But you're talking about investments now as opposed to liquidity.
That's not, I agree. And I recognize that in terms of liquidity, there is nothing else you can do.
So you're still a proponent for continuing to accumulate gold and silver?
Totally.
Let's talk a little bit about silver, because you had some specific points in this presentation this morning. You're basically concluding that the numbers don't add up. Do you want to explain that?
When I look at the supply-demand numbers from 05 to 10, we have an approximate 900 million ounce market of recycled and produced silver per year. And when I look at the changes in supply, which have increased a little, and when I look at the change in demand and supply from China, the change in demand and supply from India, the creation of ETFs in silver, which didn't exist in 05, I can come up with 380 million ounces of net change in a 900 million ounce market. And that includes the change in supply. So I could think, well, how can we go from 05 to today, and I can identify by going to 6 sources, 380 million change. How do we keep supplying all this silver to the market? And I think it seems fairly obvious to me, and it even seems more obvious having come here and see the interest in silver. As I surveyed the various sellers of gold and silver here, my question was, well, how much are you selling in gold and silver on a dollar basis? What's the ratio of the two? And I was amazed to find out that they sell as many dollars as silver